Hello everyone. While it is important to save and invest, it is equally important to monitor your returns regularly to check whether they meet your expectations. So in this video, we shall learn about how you can monitor mutual fund returns. Since mutual funds are market linked, several factors impact their returns. Performance of the underlying securities, economic changes, decisions by the government, and calls taken by the fund manager affect the returns of a scheme. So what are the parameters to track returns? Number 1. Against investment goals. The easiest method is to see whether the fund is moving towards your goal or not. A shorter term goal would need more monitoring than the long term goal. For example, monitor your fund returns more closely for a short term goal like buying a phone in 6 months than a longer term goal like a child's education. Number 2. Against the benchmark index. Another way to track fund performance is against its benchmark index. Comparing a fund's performance against the index gives a better idea about its performance and returns. You can also compare returns of a fund against its peers, that is, different funds within the same category. Note that you must compare the long-term performance of a fund, especially during the bearish phase, and see how well it has been able to contain the losses. Financial ratios that can help gauge the mutual fund returns. Certain financial ratios such as expense ratio, standard deviation, and Sharpe ratio can help you gauge the performance of a fund. Expense ratio refers to the cost incurred for managing the scheme. Higher expense ratio eats into your returns. From an investor's viewpoint, expense ratio of around 0.5% to 1% is considered good, and a ratio of more than 1.5% is considered high. Standard deviation reflects the volatility of a fund. It can help you determine how much the returns can deviate from the fund's historical mean returns. Sharpe ratio indicates the risk-adjusted performance of a fund, which means a higher Sharpe ratio denotes that the fund is performing well and vice versa. So here's how Sharpe ratio is calculated. Excess returns, that is, average return minus risk-free return, is divided by standard deviation of fund returns. So in conclusion, tracking returns of your mutual fund scheme can help you weed out underperformers and invest in funds that aid you in achieving your goals with ease. And if you liked our video, like, share and subscribe to our channel. For more such videos, visit our website www.edelweiss.in. Thank you. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.